Okay, morning. Thank you for inviting me to address you a few minutes. The title of this talk is basically to let you know why we have a strong conviction why there shouldn't be a recession at a global level. And I want to elaborate basically how to think upon data and to think objectively and not driven by press releases. And then to give you some flavor of what's happening in the Spanish economy as well as in the Spanish real estate sector. Let me start with one idea. We are Homo sapiens. So we have been living 220,000 years on the Earth. If you think about that, the first signs of urbanization started in the year 9000 before Christ. We invented writing in 3200 before Christ. And we became literate in the 19th century, most of us. So which means that most of our lives, we have been living in caves. And we were illiterate. This means that if you're living in a cave, if you want to survive, you need to always be in constant danger. I've listened to this noise, so probably a tiger is going to eat me, or there is a dragon coming against me, etc., etc. At the end, 99% of these threats are wrong. They were not real tigers or dragons or whatever. However, this is still in our nature. This means that today, when you read a newspaper, if you read the word crisis in the headline, you tend to read the news. If you read the word expansion, you don't. Because crisis thinks upon the tiger, and it alerts your animal DNA, whereas expansion doesn't. And this means that you can create a process by which, first, you could get it wrong, and second, if all of us follow our animal nature, then what happens is that we could end up creating a recession by stopping consumption and stopping investment. So what I'm going to tell you today is how to look at the world based on our rational nature, not based on our irrational nature. But it is relevant that we get to understand each other before we take these decisions. Now, this is the indicator of Google, how many people look at the word recession. As you can see, there was a sharp increase, of course, in 2009. This didn't happen in 2015 when we had the Chinese devaluation of the yuan and a big crisis in emerging markets. But this summer, the number of searches went up a lot, okay, and they came down in September, which tells you to what degree people were scared upon the threat of a recession. Now, this is the situation. Now, let me address it looking at data. First idea, which is one of the major threats you have on the global economy and the global real estate. We can talk about this a little bit later, but at the end, real estate is a huge asset class that basically goes up or down depending on where interest rates are set up. Okay? Now, we used to think upon short-term interest rates, but for real estate, the important driver is long-term interest rates because it's the equivalent. Because real estate is a long-term asset. So it's critical that all of us understand what happens with the balance sheet of central banks. If they keep going up, long-term interest rates keep being low, so this moves flow of money into real estate and vice versa. And one of the major threats I was seeing a few months ago was the Fed. The Fed was cutting down $40 billion every month from the balance sheet. The Japanese still are printing $25 billion a month, and the Europeans had stopped printing money. In other words, for the first time in 10 years, central banks were beginning to cut down the balance sheets as a percentage of global GDP. And be aware that the GDP of the world is $87 trillion, and central banks have injected 20 in the last 10 years. This is why money flows into real estate and private equity and other asset classes. Now, if this amount of monetary injections begin to go down, this is a huge threat for valuations all around. Now, what has changed in the last 2 months? The Europeans are back printing money, 20 billion a month. And surprisingly, 8 days ago, we got to know that the Fed has decided to inject $60 billion a month, buying bills. In other words, we are again in a world in which central banks are going to keep adding balance sheet, which in my opinion is quite supportive for valuations in general, as well as for economic growth, as we'll see in a minute. So, 3 points. First, I will explain why the world will not be entering into recession. There is counter factors that are producing the weakness that are going to disappear. We'll discuss about this. Second, I will tell you a little bit about Spain. At the end, as you saw in the video, Spain is going to grow 2% this year. If you look at the Spanish press, you say the economy is slowing down, very bad. We used to be at 2.4, we are now at 2. And guess what? This means that Spain is going to be growing more than Germany, Italy, France, the UK, Canada, Australia, Japan, and we're going to be growing as much as the US, and more next year. So if you think about that, this means that Spain is going to be the fastest growing Western economy out of the major nations. But I think in life, what is relevant is that we don't look at GDP growth, but we look at the risk of GDP growth. So I'm going to be sharing with you some thoughts upon the risk of GDP growth, which in my opinion is more relevant. And finally, a few ideas on real estate. When you analyze the world, I think sometimes we focus on whether the Fed is going to decrease rates this week or not, or the ECB. Let's forget about that. Let's think upon long-term trends. Because if you want to understand the world, you need to isolate from short-term factors and look at long-term factors. What you have here is how much debt we used to have as a percentage in billions of dollars in 1997, 2007, 2017, 2019, by households, non-financial corporations, government, and financial corporations. If you put it as a function of GDP and excluding banks, total debt was at 2.1 times global GDP before the crisis. Today we are 2.4. This means that today we have more debt than when the credit crisis started, which means that we have a new risk of a new financial crisis. Yes, of course, because there is more debt. Okay? But what we need to understand is the nature of this increase in the leverage. Where did it come from? To understand which are the sources of peril. When you make this analysis and you look at debt with base 10, 1996, you see that 100% of the sharp increase in leverage that has occurred in the world since the crisis has been in emerging markets. Again, this is the key source of financial vulnerability. Of course, you can increase your leverage as long as your GDP is growing a lot. But once you stop growing, a portion of this debt cannot be repaid, and this can produce a banking crisis. And if there is a banking crisis, probably you will have a real estate crisis, because both are interconnected. Okay? So the main source of vulnerability in the world, in my opinion, is in emerging markets, and especially in the corporate sector. There is too much debt in the corporate sector in emerging markets. Emerging corporates used to have debt equivalent to 0.5 times their GDP. Okay? Historic average today is at 0.9, highest ever. And it's even above the amount of debt carried by Western corporations. And this is quite dangerous. In China, it's 1.4, by the way. 1.4 is corporate debt in China. On the other hand, we have been building a world that has been quite successful because we turned globalized. Now, this is the amount of trade, export or import as a percentage of GDP. It used to be 5% in the 19th century, went up to 25%. And this meant that if you look at emerging markets, every year, 40 million people are living poverty, every year. Okay, so we are eradicating poverty thanks to this. And if you look at the West, for an American worker, the integration of global supply chains means that you can buy many more cars, toys, and clothes, thanks to integration. But this is not explained to voters. But this has been very good in general for the world. Now, this world is over, because if you know what goes on with trade uncertainty is that, of course, trade has turned negative in June. Overall, this year is going to grow just 1% trade. Okay, nominally speaking, the world is going to grow this year 3%. On real terms, probably it's going to be 5%, nominally speaking. So this means that trade, as a percentage of GDP, is going to get down. So we have touched the maximum level of globalization, and it's going to start going down. I don't think we'll get back at all to levels seen at the end of the 19th century. Okay, but in any case, this means that these sources of prosperity are coming to an end. In my opinion, what kills an economy is not bad decisions, it's uncertainty. Because, you know, if you take a bad decision on the US tariff, it's fine, this is the decision, and then you can create your factory in Monterrey and export into the US, close it in China, whatever. But uncertainty kills the economy, because then you don't know what to do. This is hampering growth in Europe because of the Brexit. It's hampering growth in the industrial sector because of uncertainty over trade. So we need to have a clear light on both items on what's going to happen. However, there is a sector that is responsible for a big portion of the slowdown of the world, and this is the automobile sector. Okay, there is a lot of short-term factors delaying demand for cars because of the change in industry standards of emission. If you look at Spain, we had a growth of 2.4 last year. This year is going to be 2%. 0.3% has been automobile, the automobile sector. 3/4 of the slowdown. Why? Because people just push forward the purchase of a car up to August last year. And then obviously the year-over-year comparison has been very weak. The production of new cars also came down. If you look at September data, this September data has been extremely strong. In Spain, car sales went up 18% and production up 8%. So the fourth quarter is going to be better. So you need to distinguish these short-term factors from long-term factors. Other thing to consider, for the first time ever, we have a population in the world that has less kids below than 5 years old compared to people above 65. This had never happened. It's the first time ever. We saw Japan. Japan is going to be growing this year slightly below 1%, 0.5% last year. This is heroic because Japan is losing 600,000 workers every year. So it's very, very tough. I mean, GDP is about number of hours worked and productivity per hours worked. And OECD, yes? This is global data? Yeah, global. And the OECD and China are now seeing reduction in the employment level because people are just retiring faster than new kids are getting. So this means lower GDP growth. And this also means that, older people save more than young people. So this means also that we're going to have, structurally speaking, very low interest rates. It's a question of demographics. The other key thing to consider when you talk about inequality, we can discuss later if you want inequality, but I want to focus, in my opinion, in the most relevant impact of inequality addressing your market, real estate, which is called metropolization. In the past, until 1970, if you had GDP growth in a country, all the towns would prosper. Big cities, small cities, it was great for all of us. And then the middle classes were having a future, other kids as well, and you had a strong connection with your political system. Since the 1970s, all the GDP activity, good jobs, high-paid jobs get concentrated in a single huge city. In the case of Spain, 1.5, Madrid, and a little bit of Barcelona. In France, it's Paris. In the UK, it's London. In the US, it's 5 cities. So you begin to see a sharp difference in terms of number of jobs and high-paid jobs. And this creates a lot of resentment out of mid-sized cities compared to large cities, which then this produces that middle classes no longer see a strong attachment to the political class, and this is a fertile ground for populism. Populism is about giving a simple answer to a complex phenomenon. Okay. Now I have this problem, we're going to solve it by building a wall in Texas, or I'm going to solve it by quitting the European Union. Fine, but the reason behind this is the fourth industrial revolution. And the answer for this complex problem is a complex solution, which means lifelong education. But no one is addressing this because human beings and Homo sapiens, they love simple answers. Now, how many jobs are going to disappear because of artificial intelligence? If you look at OECD data, more or less, in the OECD countries, 20% of jobs will disappear. In the case of Spain, 25. This is 4 million people. If you look at emerging markets, it's closer to 35 to 40%. So this has huge, huge consequences for the future of democracy and the future of our populations. Now, is this going to be the end of the world? No. Look, when the tractor was invented in 1900, 50% of US people worked in agriculture. The tractor is a robot, and they got scared to death. They said, this is the end of works. And today unemployment stands at 3.5%. So history teaches you that despite huge shifts in the technology impacting the job markets, you create jobs in other sectors. But in the meantime, this can create plenty of social convulsions and geographic dislocation, as I've shown. So what's happening in the world today? The first reflection is the US dollar. The US dollar, it was said by a US Treasury Secretary, it is our currency, but it is your problem. Why? It's very simple. The US is 10% of global imports. It's 15% of global GDP. 1/3 of countries around the world have their currency pegged against the dollar, such as Hong Kong, Saudi Arabia. And 50% of all the trade in the world is conducted in dollars. And 2/3 of all the issuance of international securities are done in dollars. Which means that if 50% of global trade is conducted in dollars, as a central bank, you need to have at least 50% of your reserve in dollars to be able to pay for these imports. So you rely on the US dollar, yes. And second, if you're a Turkish corporation, do you prefer to issue your debt in liras at 12%, or in loras, or in dollars at 7%. You go for dollars, at the same as Argentina. But what happens when the Fed moves up rates and the US dollar goes up against the Turkish lira or the Argentinian peso? You get your income in pesos, and you have your debt in dollars. Guess what? You default. And when you default, the local banks default, and you have a crisis. And the country could end up defaulting, such as Argentina. And Turkey is living a lot of difficulties. Lebanon is living a lot of difficulties. And this is the main problem, structural problem that is going to keep being there, because there is not an alternative for the US dollar. We can discuss it. Why? So what's going on with the dollar? The dollar is very expensive for any valuation methodologies. Why do people keep buying the dollar? It's very simple. If the growth of the US is 2%, the Eurozone is close to 1%, and interest rates are 2%, 1.75%, and in Europe are 0 or minus 0.5%, this means that if you have money, you'd better be in US bills, which are going to pay you 1.75%, than being in Greek bills that pay you a negative rate. So today, Greece is auctioning debt at a yield below that of the US Treasury. So if you're Greek, you understand that it's better to be in the US Treasury than in the Greek Treasury, so you buy the US dollar. It's basically the differential in interest rates. So probably if there is a recession in the States, and then the Fed moves down the rates to 0, this will change the price of the US dollar. But in the meantime, this is going to be the situation, it flows. On the other hand, I was telling you that part of the reason of the weakness of the world is uncertainty in trade. The second reason is uncertainty on Forex. If you want to set up a factory in Mexico so that you can produce to sell goods into the US, which then get remanufactured and sent into Europe, you need low volatility of peso against dollar, dollar against euro. When volatility of the big currencies go up, then you have an issue. Are you going to be putting your factory now, or you wait until the whole situation clears off? And this is the other key source of uncertainty we need to address. Now, are we going to be seeing a recession in the States? Basically, as you know, the yield curve inverted in May. And when the yield curve inverts, always you have a recession a year and a half afterwards. So this is telling you that there is a recession coming in the States, fourth quarter next year. But there is other signals for recession, such as spreads, corporate spreads. When they go up, they are telling you a recession is coming. Corporate spreads didn't go up. So we don't have all the signals pointing towards a recession in the States. My main idea is very simple. We need to distinguish great recession, such as the one we saw in 2009, from a technical recession. Technical recession means 2 quarters of negative growth. That's it. Germany is going to have a technical recession. Minus 0.1 and minus 0.2, that's it. If there is a recession in the States, it's going to be a technical recession, not a great recession. A great recession is when you have, at the same time, a housing bubble that exploits, banking crisis, and then a huge recession. It happens once every 50 years, 1929, 2008. It's not going to happen this time. You don't have a housing bubble in the States, and you don't have a problem with banks. They are well capitalized. Only a technical recession, which is the typical stuff. And guess what? If the US GDP falls down 0.1 one quarter and 0.2 the next one, it's okay. It's okay. There is no issues with the global economy. However, this can produce a political effect, which is that Donald Trump gets defeated in November. And that's the reason why Donald Trump has been so strongly advocating for the Fed to cut down rates, to make sure that this impacts the economy and avoids a technical recession. Okay, this is the political consequence, but nothing to worry about, in my opinion. If you look at GDP of the US, this second quarter, consumption was doing okay, that's blue, but you had a lot of negative performance in terms of exports because of strong US dollar, and in terms of investments because of uncertainty. So the critical thing, if you want the economy to keep off and not to enter into a recession, is to avoid this uncertainty. Okay? Unfortunately, we are not there yet. The only hope for the US is consumption, which has been strong up to August. And August and September have been quite weaker. So the key dilemma is, we have today in the world a recession in the industrial sector, manufacturing sector. Yes, there is a recession in that sector. We don't have a recession in the services sector. Now, industry represents 11% of US GDP. Services is 80 to 83%. So the critical thing when you want to assess the world economy or the US economy is services. Now, is the weakness in industrials explaining more weakness in services? Yes. Do we have any data that supports the thesis that services are today in recession? No. Services are expanding in Europe, in the US, as well as in China. Up to now, we don't have any hard evidence that services are contracting. And as services are the main sector in the world economy, that's the main reason why we shouldn't see a recession. The second argument is that 50% of the weakness in industrials are driven by one sector, which is automobiles. 50. And let's see what happens in the fourth quarter once the scheduling effect are off. Okay? So I would be expecting a smooth recovery of industrials starting in the fourth quarter, okay? And I would be expecting the services sector will keep doing fine. Will not get into recession. Why? Because services is about having a beer or is cutting my hair, and this basically depends on to which degree people are perceiving that the employment market is strong and to which degree salaries are going up. And guess what? Salaries are going up and we are still creating jobs. And there is not a sense that people are scared because companies are cutting down the amount of employment. That's why services will do okay, in my opinion. The main risk for the global economy is China. And the reason is, the latest Chinese statistics told us this week that China is growing at 6%. Now, 6% could seem that is great, but it depends on the amount of debt you have. Okay, the growth depends on the debt. And the key issue is not how much you grow, but how much debt you have. Now, if you look at the evolution of Chinese debt as a percentage of GDP, you have here the evolution. Up to 2006, it was nice. 1.5 times GDP is okay. The problem is that the country entered into a new model, which encouraged a lot of lending. And today you have a level of total leverage of almost 3 times. And this is very dangerous. And the key source of vulnerability in China is the corporate sector. Above 0.7 is dangerous, and China stands at 1.4. And a big portion of this is Chinese developers. So if there is a change, turning around of the Chinese real estate sector, there could be an issue. And this wouldn't be a technical recession. Okay, this is the main risk. I think the Chinese government is aware of this. And that's the way the Chinese government has been doing a lot of easing, both fiscal as well as monetary. And the key issue is to which degree the financial imbalances in the Chinese real estate sector can produce a problem with this amount of debt. If there is a problem, this would be a domestic problem, not an international problem. The situation in China, the slowdown in China, means that they are buying less goods. When they buy less goods, guess what? They import less raw materials from Africa, for instance, or from Latin America. So today we're going to have a very bad year for emerging markets because they're going to be growing only 4%. Average growth of emerging markets has been quite stronger in the past. But in any case, if emerging markets grow 4% and they make up 55% of the world, and OECD countries grow around 1.2, 1.3%, and they make 45% of the world, make the numbers. Not a recession. It's just maths. A few thoughts on Europe. Germany will have a recession, yes, because they lost 0.1% percentage of GDP in the second quarter, and probably they will lose 0.2 in the third quarter. Yes, there is a recession. But had they achieved 0% growth the previous quarter, then that wouldn't be a recession. So the question is that 0.1% of German GDP so relevant? We'll see the word recession in the headlines and we'll get scared as Homo sapiens. But rationally speaking, it's peanuts. It's just 0.1% of GDP. And probably the fourth quarter, you will see again the economy growing. It's going to be a sluggish growth because, when you have very low unemployment, it's very tough to grow. It's going to grow only 0.5, 0.4 this year. I think we'll grow 1% next year, but that's it. So where do you have the PMIs? If you want to understand the future of the world, don't listen to economists. Basically, the best thing is to listen to people like you. And people like you, every month, they conduct a survey called the PMIs, Purchasing Manufacturers Index, thousands of you, and you answer. Above 50 is good, below 50 is bad. What you have now is manufacturing sector in Europe is negative. It's around 46 because of Germany, but services is positive. It's weakened, but it's still positive. Now, what's going to happen going forward? I have a clear view. The industrial sector will recover in the fourth quarter because of automobiles. And services, it will keep expanding as long as the employment situation keeps being okay, and salaries are growing. Salaries are growing 2.5% in Europe now, 3% in Germany. And we are creating jobs at a pace of 1.3% per annum. So with this environment, I don't see people stopping having beers or cutting their hairs. Services is going to keep expanding. Look at an example, Germany. If you read about Germany, it seems that this is the sick man of Europe, everything is very bad. Retail sales, German retail sales. People are going to the shops. Why? Because they perceive they have a safe job. There is no unemployment. And you get your 3% nice salary increase, inflation below 1%. This means there is more money in your pocket at the end of the month to be spent in beers. Unless you see this into the negative, you shouldn't worry. And there is no signals upon that. Addressing Spain, now if you look at the newspapers, I think Angela Merkel was questioning our Spanish Prime Minister on the weekend. What's happening in the Spanish economy? Because if you read the newspapers, slowdown in the Spanish economy. Well, the Spanish economy has been growing quarter over quarter, starting on the second quarter last year, 0.5, 0.6, 0.5, 0.5, 0.4. And it's going to be growing 0.5 and 0.5 the next 2 quarters. So the slowdown has been 0.1. That's it. Okay, that's headlines versus reality. So Spain was growing 0.5, 0.5, 0.5, and it came down to 0.4 because the savings rate went up in the second quarter because people were scared, looking at all these news about recession. But look at the performance of Germany, Italy, and France. Again, when you look at daily econometric models, which forecast what's going to happen with the economy the third and the fourth quarter, I looked at them yesterday night, 0.5 and 0.5. Overall, the Spanish economy is going to grow 2%. Is good or bad? I mean, this global context of weak growth is extremely good, in my opinion. 2% growth is going to be the best in major Western economies. And what happened in the second quarter? You know, household income went up 5% because salaries at the end are starting to grow in Spain. Spending only increased 0.8. Why? Because the savings rate went up. Is this sustainable? No. We're going to keep receiving 5% incomes every month in our pocket, and we'll spend it, which means that we can support growth going ahead. And this will mean that Spain is going to keep growing above other countries because we still have higher unemployment. This is what happened with the savings rate. Today it's above the historic average. This is not sustainable. And it is easy to grow once you still have high unemployment, 14%. Much easier to grow than if you have 3.5, such as the Germans. So in my opinion, this tells you that we have growth in the next 2-3 years, very easy growth, which is going to be above that of the Eurozone. Now, the key wind supporting Spain is going to be salaries. Spain did increase its salaries the last 10 years because of the crisis, but productivity went up 10 points. So if you look at the data today, if you look at OECD data, an Italian produces 42 euros the hour, a Spaniard 41, a French 53, a German 53. But which is the cost, labor cost per hour? Italy 28, Spain 21, France 36, Germany 35. This graph, and this is Eurostat data, tells you why Spain today has done extremely well in exports. Spain is exporting more as a percentage of GDP than the UK, France, or Italy, or the US, or China. It's because of this. And second, it tells you why we keep receiving a lot of foreign direct investment, because money looks for fundamentals, and these are the fundamentals. And third, it tells you why Spain can afford to move up their salaries. It's growing at 2%, salaries already, exactly the same as in the Eurozone. But you know, inflation stands at 0.1 in Spain, which means much more money to be spent on beers. And that is going to support growth in the next years coming. This is the evolution of labor costs, unit labor costs of Spain and the Eurozone. Before the crisis, our costs were moving well above the Eurozone. We were losing competitiveness. Now it's the other way around. We've gained competitiveness. But the key thing in life is not looking at growth, but looking at the risk of growth. Spain was growing at 4% in 2006, and you had to be completely crazy to invest in Spain in 2006. Yes, we were a AAA economy, but we had a huge housing bubble, and we had a huge current account deficit. If you invest in a country with current account deficit, what this means is that you don't have enough savings to support your investment. So you need to borrow your money from elsewhere. We were borrowing 100 billion euros every year from the Germans. Okay, huge current account deficit, the second largest in the world. Now, if you invest in Spain at that time, yes, AAA. But once the Germans stopped funding Spain because of the crisis, the economy contracted 10 points. So this is basically why people have lost their money in Argentina or in Turkey. Huge current account deficits. Now, today, for the first time ever, or at least in the last 50 years, Spain is able to grow, whereas it sustains a current account surplus. And this is very important to understand the risk in a country. And I think this is very relevant. And the second key risk when you look at a country is to which degree you are growing at the same time as households and corporates are adding up debt. Yes, you are achieving growth, but bad quality growth, because you rely on debt. Sooner or later, the party is going to end, and then you're going to be suffering. So Spain, look at before the crisis, debt of the Spaniards was 50% of GDP, went up to 85 in just a few years. Huge housing bubble. Housing bubble collapses, huge banking crisis, great recession. But look at Spain since 2014. The country has been growing nicely. Look what debt is doing of households coming down. Even if you put together the debt of the Spanish government, households, and corporates, it's coming down. It's one of the few countries in the world where total amount of debt is coming down. If there is a new crisis, you want to be exposed to countries which do not rely on debt. And this is critical. And if you look at politics, if you are based in New York, you just think, if you invest in Europe, you want the two-party system. It could be good or wrong, but you know more or less that what you are up to. Okay? And one of the few countries where you still have a two-party system, a strong two-party system, is Spain. And I think this is a key difference. And the second difference, even if you look at the Spanish populist parties, they support the euro and they support the Stability Pact, which nothing to do with France Le Pen or the Italian Cinque Stelle or Alternative for Deutschland or whatever in the UK. And I think this is quite relevant to understand that why, at the end, we have some stability in politics. Because, you know, in Europe, there is not much room to maneuver. You have to do what you have to do because you have these pacts with the European Union you need to comply with. A few thoughts on monetary policy and private markets. First idea, I've told you about long-term interest rates. Let's talk about short-term interest rates. The Sumerians, they invented finance in 3200 before Christ. Because they invented finance, they also invented writing that year. And because of that, we know the interest rates of the Sumerians were around 20%. And we can track interest rates since the Sumerians, the Egyptians, the Romans, the Greeks, Middle Ages, up to now. So today we have the lowest interest rates in the last 5,000 years. Is this going to change going forward? Probably. And history teaches you that normally things revert to the mean. But we never had this demographic profile in the world, never. Which means that having the lowest interest rates ever means that you're going to have asset prices above historic averages. Okay? And this supports real estate, this context of 5,000 years of low interest rates. So what do you do with your money if interest rates are very low? Then you just avoid government bonds because they have crazy prices. Spain is raising finance today at 0.2% 10 years. The US Treasury 1.7. Spain has defaulted 13 times in the last 200 years. The US never. Does it make sense? No sense. Basically, this price is manipulated by the ECB. Okay? So what do you do? Basically, what you do is that you move into other asset class, investment grade. How much does investment grade pay you? Exactly the same as the government bond, nothing. So you go one step forward. You go into junk debt, high yield. Anyone knows how much does European debt pay you, corporate debt, junk debt, high yield? 2%. 2%. You call it high yield, I call it low yield. But these are junk bonds. 2%, which is a PE of 50 times, by the way, if you look at the inverse of it. It's crazy. So what do? You cannot invest in this asset class. You go elsewhere, equities. Look at equities. You could discuss whether equities are cheap or expensive, but you know, Professor Shiller, the Nobel Prize, he said, look, if you want to make money in the equity market, forget about looking at short-term PEs. Because you know, at the end, if the net income margin, net income divided by sales goes up, okay, yes, you could think that the equity market is cheap, but sooner or later, the net income margin will go back down to the average level. And based on this, he built this methodology, which is in the Yale web page, called cyclically adjusted price earnings. Basically, it looks at how much you are paying for the market, taking into account that the net income margin will normalize to the average of the last 10 years. Today, you are paying 30 times adjusted earnings. We only had this valuation 2 times ever, 1929 and 2000. That's why when you discuss with asset allocators on the equities market are also expensive, when you think that corporate margins are starting to move down in the US and in Europe. This is very risky for valuations. So what do you do with the money? You go into alternative assets. So you buy venture capital, private equity, infrastructure, and real estate. Okay? And this basically produces a lot of flows into these alternative classes, and this produces plenty of implications for M&A as well as for the financing markets. I was looking at one statistic that tells you what's going on. In the year 2000, you had 7,000 companies listed in the US. Today, there is only 4,000 left. The number of companies financed by private equity in the US in 2000 were 2,000. Last year, 8,000. Money is going into private markets. The same is happening with the debt markets, direct lending. Why? Because there is less regulation at the end. And of course, money goes into real estate. Let's look at housing prices. In this environment in which central banks are printing money, you begin to put water into the bottle and all the ships go up, of course. So what happens with housing prices? All of them have gone up compared to 2007 levels. Okay? Some of them have reached the same level on real terms. Some are well above 2007, such as Australia or the UK. But Spain is one of the few countries in the world where you still have house prices 15% below 2007 levels. So is there any logic on why Blackstone or Cerberus are aggressively buying real estate residential in Spain? Yes, they think, look, if there is a change around in the interest rate situation, I want to be in countries that are not having asset prices well above 2007 levels. One of the few asset prices that is not expensive in the world is Spanish houses, and that's the reason why they have been buying it aggressively. And the final idea when you value real estate, I was telling you that real estate at the end is an alternative asset class, and obviously people compare it with 10-year bonds, government bonds. My father, with his savings in the past, he could have Spanish government bonds, which would yield 5%, and he could live out of that. Today, he must choose with his savings. Should I buy the Spanish government bond yielding 0.2, or I buy a house and I rent it? If you buy a house and you rent it, you get a 4% rental yield, and the house price is going to go up 5%. So you get 9% return with the Spanish houses, or you get 0.2 with the government bond. It's very clear why people go into real estate. So follow this logic. If you look at residential, in general, I don't know your countries. In the case of Spain, I've looked at 40 years of data. Always, the Spanish bond was paying you very similar yield than the rental yield. It was paying you 0.4% more. The rental yield than the Spanish 10-year bond. Today, the spread is 3.5%. So they should be priced at the same level. And today you are having 4% rental yield, 0.2 in the 10-year bond. Doesn't make any sense. So will you see further yield compression? Yes. Look at logistics. Historic spread, 3.4%. Today, 3.9%. Same logic. Look at the office market. Historic spread, 1.5%. Actual spread, 2.7%. So are you going to be seeing deals in Madrid Central Business District at 2.5%? Yes. Because if you are an insurance companies, and you used to have Spanish bonds, you bought Spanish bonds in 2012 at 7.3%. That year, Spain was considered to be a riskier country than Egypt, Philippines, and Kazakhstan. Okay, and the Spanish credit default swap was worse. And you bought these bonds, and in 2022, they mature. What do you do with your money? Can you reinvest you cannot invest in bonds. So you will end up getting into offices, and you will see further compression. And the same with prime retail. 3.9 is the actual spread. Historic spread was 2.7. Now, what's the future of interest rates? Don't listen to people like me. Again, look at the market. John Gabriel said that economic predictions make astrology a respectable science. This is the consensus. Look at the consensus and ignore me. And I just tell you what I see in the consensus. Today, the consensus is telling you that interest rates in Europe are going to be negative the next 10 years. And they are predicting that in the next 50 years, the Euribor is going to be below 0.25%. This is the futures market. Is this a market supportive for real estate? By all means, because there is this transmission mechanism I just mentioned before. So you go into the private market, which is alternative assets. People more or less today have 10% of their asset classes allocation into alternatives. So they have private equity, they have real estate, they have infrastructure, private debt, natural resources. So they have already $5 trillion invested into these things. $5 trillion. Now, how much of this is dry powder? which means that you have committed capital which you have not deployed, more or less 1.2 trillion. So are you going to keep seeing a strong M&A market? By all means. Is this supportive for valuations? Yes, because these guys, they need to invest this money. Buyouts, venture capital, growth, this is just equity. But at the end, this also explains why the M&A levels are very strong. Last year was the strongest ever. This year is going to be lower than the previous year, but it's going to be one of the strongest ever years of M&A. And I think this trend is going to keep on, because low interest rates, a lot of equity being raised means that there is going to keep seeing M&A activity. So conclusions, mathematically speaking, the world would not see a recession. It's not going to happen. What you will see is weak growth, 3% this year, probably 3.4 next year. And why there is not a recession? Because part of the weakness was short-term driven by one sector, and part of the weakness was more structural driven by uncertainty. I think uncertainty will disappear in the fourth quarter. Good or bad is going to happen with the Brexit and with the Chinese-US deal. And the automobile sector will recover. So I think next year we'll see bad growth, but better than this year. By the way, average growth of the world has been 3.7 the last 10 years. That's why 3 is bad, but it's not a recession, by all means. I think monetary and fiscal policy are going to be in the same direction. Monetary policy is going to keep being quite weak in the sense of further printing of money and low interest rates. The Fed will decrease interest rates again this week, and today the key issue is that we are moving from monetary policy into fiscal policy. And this is going to happen, yes or yes. Can we afford getting more fiscal policy? Yes, because there is a lot of public debt. But guess what? The amount of GDP you spend in servicing your debt is at very low levels because of QE. So I think that we're going to be seeing more fiscal stimulus. In China, it's already happening. Germany has announced a package of 1.5% percentage points of GDP. France has announced 0.5. This is going to happen, fiscal policy. Okay. And that's why if governments start spending money, you should not underestimate the risk of inflation. Because as the Germans know very well, when the government spends too much money, you create inflation, as it happened in the Weimar Republic. And I think in Spain you have very good fundamentals, because at the end, 2% is not great, but it's quite decent in this context. But the key issue is not 2%. It's the fact that you are growing at the same time as you are deleveraging. This is the key binomium you need to master when you invest around countries. Let me end up with one idea that I shared with Sandra a few months ago, but I didn't have the slide. You are here together, and what you find in life is that at the end, it's not this kind of speeches or interaction by email what helps you to make business. It's basically interaction between human beings. I see it, I think they mentioned that we have an alliance with Jefferies. We have 9 sectors. Those sectors that have a higher personal connection between Madrid and London are those which are making the business. No? But you guys have decided to commit your lives to real estate. No? And you have Japanese here, but the Japanese have a way of thinking upon how you decided to spend your life. It's called the ikigai. And basically what they say is, look, when you decide whether you have a great job, which is the ikigai, you need to fulfill 4 conditions. First, doing something you love. Of course, it's one of it. But if you make something that you really love, you also have to think that you are good at it. Because perhaps you love tax advising, but perhaps you are a bad tax advisor, so you have a big problem. So you need to understand these 2 factors, which are critical. And if you got the 2, you have a passion. But guess what? You also need a profession, because you need to get paid. So perhaps you love to teach young children who don't have very good economic conditions. You're good at it, but you don't get paid for it. So you have a problem, because sooner or later you want to raise your children and to have, so it's very tough. Some people are very good at tax advising, they don't like it, and they get paid for it. This is a profession. Most of the people are in professions, but they don't love their profession, and that's why they hate Mondays. And finally, if you have a job that you get paid for it, you're good at it, you love it, and also it's something the world needs, it's something which is quite weird, because sometimes you go as a missionary into a country and it's good, but you don't get paid for it. But the question is to find the 4. And you think in your sector, real estate, is one of the few sectors where I find people who really love what they do. They tend to be good at, because they have bypassed the crisis. You can get paid a lot of it, a lot of money for real estate, and of course it's very necessary for the world, and this is the ikigai. So think upon that, because I think it's relevant for the life that you choose to have, which is real estate, and it's something you should be branding when you talk to society, how relevant real estate and your profession is for the rest of the world and your societies. And I think that's it. Thank you.